Oh, sorry, it's off by $40, but yeah, okay, that's why they were so close. I thought I was
No.
at an error.
I guess it just did. That's it.
Okay.
So this will be, and also this will be a gain,
Okay.
liabilities, and
Okay.
yeah, that's it. Again, this one, it gets kind of kooky, like the income statement. You can have multiple different rates. And, and the way you got to think about it is that they're transferring that money at that time, whenever they receive it.
Mm-hmm.
And, so that it isn't like it's just going to stay in that country. It's being transferred into US dollars. So that's why they get really kind of crazy with it. The accounting's done exactly like it would be done if you bought, for instance, this equipment, the depreciation, that is when you bought it, not the current rate, which is different, than just translating the numbers over at one point, because this is when you actually bought it. If you had it on your books, it would be been on at that price. Down here, let's go down here to this property, plant, and equipment. When you bought it, this was the exchange rate. This is what you paid for.
Mm-hmm.
So this being the historical cost is what you actually paid for, and that's what you're going to be depreciated in US dollars. If it's in the foreign currency, it's going to be depreciated in the foreign currency. It's not going to have that same.
Right.
It's going to be depreciated based on this. This depreciation expense is in British pounds, not US dollars.
And you said that if they're in other currencies, they generally don't do LIFO or FIFO.
Yeah, well, foreign countries, if they're following the international standards,
mm-hmm.
They
Okay.
I should say for reporting. My Appalachian roots are coming out. So it's the they call this IFRS usually. Oops. And that's what most foreign countries are using, the IFRS standards. And IFRS standards, they actually will vary a little bit between countries, but
right.
Almost all of them use the current values for inventory at the end of the year. They don't worry about LIFO, FIFO, whatever you have, whatever the current market is. They put that on the books. That'll be gain or loss. Gain or loss on inventory. That's common for them. They don't. It's not that big a deal. And to them, they say, okay, look, we put the cost of goods sold are going to be done at historical cost.
Mm-hmm.
And any change in the inventory will be listed separately and say, okay, here's a gain or loss, but this is based on the inventory values, not anything we did operationally.
Mm-hmm.
So they have a little bit different. And to them, it's like, okay, this is like an accurate cost of goods sold, and it's also your inventory is at current values at the end of the year, so it is also accurate.
Mm-hmm.
In the United States, we have LIFO inventory.
Right.
And LIFO inventory, last in, first out. It's for more accurate accounting for the income statement. But the inventory on the books, if you never sell all the way down, you never get to the first ones in. So you get, for LIFO, our LIFO method, which you can't use in international statements, the LIFO method, you can have inventory prices from 1933.
Right.
Because it never gets sold, it never gets sold out. So I think that's one of the reasons why they don't like it, is they say, okay, you get this Mickey Mouse number on the financial statement, it has nothing to do with anything. So, that's why they always do the current market, and they update the prices to it.
Mm-hmm. Okay.
Yeah, and if, well, you can have inventory at different, using different methods, but in the United States, if you're using LIFO, and you could be having, you could translate these into LIFO. That would be even less fun than this. So, okay, well, yeah, those happen to come out pretty close to the same.
Yeah.
Yeah. Okay. Well, and you know why it is. It's probably because of this. Yeah.
Right.
Yeah. If you look at the balance sheet, the only thing that really is different is the property, plant, and equipment, and those are pretty close to, they're off by 2 cents on the exchange rate. So that's the only ones that are off here. If inventory would have been put in at historical in 129, it'd been a little bit different. But again, a lot of times they'll just do it. Okay. Well, so I think I'll send you out one of those exam to do.
The what?
I'll send you an exam on these.
Oh, perfect. Yeah.
Yeah. It'll be similar to what these are. Similar layout. Yeah. And again, it's mostly just it's mostly the idea of things being either in the foreign currency, depreciated, cost of goods sold, all that kind of stuff in the foreign currency, or if it's in the U.S. currency. And if it's in the U.S. currency, you assume that everything is done at U.S. dollars.
Right.
So the depreciation is at U.S. dollar. It's not British pounds or whatever.
Right.
So, and again, it's just, it has to do with just the function of currency. And again, a lot of times these are not very big amounts, but sometimes they can be. And they have countries that, for taxes and stuff, have huge dollars. I told you that Apple was paying 0 taxes in Ireland.
Right.
Yeah. So anyway,
Ireland, right, was the one that had like 0 taxes for them.
Well, their regular tax rate is 12.5%, which is less than anyone else in the world, pretty much. But and then actually, they did a conference on this, and with the Europeans and the United States and all that, trying to get a minimum corporate tax. Ours is at 20%. So but they're trying to get a minimum tax so that countries don't compete by cutting all the taxes out, because when it happens, they don't have any. Governments don't have any revenues, and
right. But that's also a problem just in the U.S., right? Like Delaware versus,
It's a terrible cycle.
Yeah.
Because they pay all this money out to get these jobs in, and the minute that they sign the deal, the companies start looking for somebody else, if nothing else, is to play against them. It's a horrible way to. But anyway, so they're trying to get a minimum tax, and they're trying to get Ireland to raise their taxes up to 15%. But Ireland doesn't want that because they want the jobs. So, it's tough. But yeah, they negotiated with Apple at 0%. I think I told you they had some crazy amount of cash in Ireland, like 300 billion in cash, or some crazy number. And if they brought it to the United States, they get hit with a 20% tax.
So,
right. So it's just sitting over there. They don't need it over there, but that's where it is. So it's one of those things that's kind of, okay, that's a problem. You can't, if you bring it in to pay your shareholders or something, it's going to pay 20% tax on it. So anyway, yeah, so this is the exchange rate. Again, a lot of times they're not that big a deal, but they can be huge depending on what the exchange rates are. And again, if you're wondering, well, which ones they use, a lot of times if they're going to stay in the market, they just leave it in the foreign currency. If it is if it's a country that has high inflation, then they transfer it to U.S. dollars as quick as they can, because they may have inflation of 20% a week or something. So they will. If the country has high inflation, a lot of times they will go ahead and transfer into U.S. dollars. just so I don't lose lose on the translation. Okay, let's see. Okay, so I'll send out a test on it later. And let's see here. So today I think we're just gonna kind of try to get familiar with the governmental accounting stuff. So I think there should be one that says Chapter 11 Fund Accounting.
Yes, we got that.
Yeah, and so we're gonna go over the basics of governmental accounting. And one of the things whenever you do accounting, obviously, is that you try to get familiar with the company and their business and all that kind of stuff. And the same thing is true for governmental accounting. Get used to how they actually function. Now, government accounting. So this is basically governmental accounting. Sometimes called fund accounting, but governmental accounting is different than regular accounting because you're not interested in profit. You're not interested in, are we making money? There are no owners.
Right.
You don't get a dividend from Chicago, or it's so there are no owners. The owner is whatever the organization is, and they're not trying to make a profit. And if you notice, like in our accounting, a lot of our stuff is look at how much income did you make, how much and they really don't think in those terms. They think in terms of more of a fund. How much is in the fund? How much can we use to do whatever we need to do? And so one of the things we're going to kind of break up here is the different types of funds and talk about the different types of funds. And then there's also two different types of accounting that we'll talk about for a little bit here too. And we'll come down here to some of the strange nitty-gritty stuff. Okay, general funds. This is what you normally think of when you think of government stuff. A lot of stuff falls under the general funds. Education. Streets and sanitation. Water. Basically, all those things that are you normally think of the police. Sometimes called public safety. You might also have the fire department in there. And again, just like every business will have things they group together. So police and fire might be grouped together. You might have education, and maybe you have a library fund too. Underneath there is a sub fund. And a lot of times you have a general fund that have some of their own accounts. There are things like the mayor's office and that kind of stuff that are generally not a function. They're there to building and permits, maybe.
Right.
Like building and so building and permits. So these are all. Oops. Hey, they should call them permittees. Some people would feel so bad about having to pay for building permits. Oh, those are permittees. Oh, okay. So these are kind of the things that are in the general fund. Now, again, these things are not money makers usually. Usually you pay out for education, you pay for the libraries and the streets and all that. You don't make money on the streets and sanitation and all that kind of stuff. So this is all the stuff that people, if they didn't have to pay, probably wouldn't pay. But as a government, you need to pay those things. So police and fire department. And again, most of these things are not money makers. The police might, and fire department, they might hand out, police hand out tickets. Fire department, so for their services, they bill out to. Library, maybe collect some fines and all that, but usually they're not enough.
Right.
So these are not money makers usually. So general funds, a lot of their money, especially if it's a local, let's say a local government, a lot of their funds come through property taxes.
Right.
And the nice thing about property taxes is you can use them for anything. So if you need money for the library or whatever, or water or whatever, you can use property taxes for it. So a lot of times these are kind of shored up by the property taxes.
Mhm.
And that's usually the general fund. Special revenue funds, kind of wacky that they are funds that can only be used for special purposes. Okay, so example. The gas tax can only be used for road repair. So something like the gas tax, you can't use the gas tax. If you guys receive, if you receive gas tax money, you can't use it for your library.
Right.
You can only use it to repair the roads. And so sometimes you hear, oh, the government has this money, but they can't pay it out. Whatever. It's probably because it's a special fund. It's, somebody can only, they get grants from different government agencies that can only be used for education. You can only use this for educational purposes. You can't use that to pave the streets. So these special revenue funds, these are funds that can only be used for specific purposes. And if they are not used for those special purposes, they're not considered revenue and they must be repaid. So a lot of times, you hear about, oh, they'll spend all the money out of this fund because, a lot of times if they don't spend it, it's not earned. And if it's not earned, then it goes back. It's sort of like a liability. So for instance, if they if you get $10,000 from the gas tax for working on roads, if you spend 9,000 of it, 9,000 is all you've earned. The other 1,000 goes back. So that's why people say, well, you got to spend it or else you're going to lose it. They find something to spend it on. So that's one of those things. If it can get carried over, it's known as a deferred revenue, which we'll talk about later. If they can defer, if they can, we don't need it this year, but we will need it next year. Sometimes they can defer it. It just depends on the fund, how it's set up. But so special revenue funds, they can only be used for a specific purpose. It might be education, might be road repair, maybe whatever. Debt service fund. These are funds that are used to pay off they can only be used but they can only be used to pay off long-term debt. City issues bonds. They have the debt service fund, and the debt service fund will actually pay those off. And this is kind of a strange thing, and for one type of accounting that we're going to see, they don't keep long-term debt on the books. So they have to transfer money to this debt service fund because the debt service fund will have long-term debt. That's all it has is long-term debt.
Okay.
I know it's kind of strange, but that's kind of the way they do it. Well, I
What's
think we
considered long-term debt in this case?
Anything over a year. And by the way, another weird thing about government agencies is they usually have a July 1st to June 31st year. It's sort of like just the opposite of most businesses have a year end of December 31st. Yeah. So they have a July 1st through June 30th. So July 1st, 2021, and then the year end will be June 30th, 2022.
And that doesn't apply to nonprofits, right? Just governments?
Usually just government agencies. Nonprofits can also have a different year ends, and sometimes
Right.
they will have these, but for government agencies, a lot of times, and here's what happens. You notice that, like, United States, usually they have elections in February, March, to figure out who's going to be elected, and then those people will take office on July 1st. July 1st, they have to have a budget and all that kind of stuff. So, it's sort of, I don't know, it's just a cycle that we do in the United States. And so that, the new government coming in will have a July 1st that they'll start their period. This is 2021 through
Right.
2022. It can be a little bit confusing sometimes when someone says, is this for
Right.
2021 or 2022? And well, a lot of times I'll use the first year as the year. 2021 will go through 2022, but sometimes it can be confusing. And anyway, so long story short, basically, this is the length of time that will be on the books for what they call fund accounting. The stuff from July 1st through June 30th. Current year, only current assets and current liabilities are on. We'll talk about this in a little bit here. But anyway, that's why it's kind of strange in that you see this debt service fund and say, well, why would that? We don't have a debt service fund for private accounting. Why? They just have it. They just have an account with your long-term liabilities. They don't have that. So that's why we have a debt service fund. Okay, capital projects funds. These are for building projects. Oops. So roads, buildings, bridges, sidewalks, whatever. And these funds, the project funds themselves can either be specific for a specific task, or sometimes they'll have a capital projects fund, and then they'll just have a listing of the number of projects going on. But you'll notice that these projects are generally not, well, they shouldn't be ongoing. I know the roads are, but they shouldn't be ongoing. So for instance, we're going to repair 22nd Street. Once 22nd Street is repaired, that capital project fund disappears because it's done. So as you finish a project, the capital project funds will disappear. But they'll stay on the books until they are completed and have all the costs going into it and all that kind of stuff. And all the funding and all that will go through the capital project fund. But again, once they're done, they're taken off the books. They're closed out. So it's not like education. It isn't like you close the schools after you graduate. You keep it open, year after year after year. Whereas these funds usually have a finite life. It's only for the building. So once we're done with them, they well, I keep forgetting I'm back. You know, you have so many more choices in Excel
Mhm.
colors. So they usually have a finite for a period, and again, once they're completed, they're taken off the books.
Mhm.
Permanent funds. Permanent funds are kind of different in that these are usually funds that only the income can be spent. So they're around permanently. Okay, so Mr. and Mr. Walters die. They leave $100,000 for the library
Mhm.
and investments, and the library can only use the income from the investments. So the investments themselves cannot be spent, but the income generated by those can. So if they have gains or dividends or whatever, the library can spend that, but they can't spend the $100,000. And so they're permanent because they'll just be there forever,
Mhm.
throwing off whatever income they make.
And
So
those are generally also, are those also considered like special revenue funds in that they're only for a specific thing, or?
they can be. They're not actually considered special revenue funds because special revenue funds generally can be spent in their entirety.
Right.
We used to talk about these two together. The way you're thinking is not wrong at all. But yeah, a lot of times these funds can be only spent on one thing, drug rehabilitation. So someone leave some money for a specific purpose. Sometimes they leave it just for general. They say, just to the city or whatever. But sometimes they leave it for a specific purpose, and those can only be spent. But if they're going to be there forever as a permanent fund. Now, the same people donate $100,000, and the entire thing can be used, but only for the library.
Mm-hmm.
That would be up here. It would be a special revenues fund. It can only be used on, so it's not earned until they spend it, and it can only be spent on the library.
Mm-hmm.
If it's not spent on the library, it's not earned.
Okay, that makes sense.
So up here, these are going to be spent in their entirety usually. Down here, these are, they can't be spent in their entirety. It's only going to be for the income usually.
Okay.
Okay, so types of governmental accounting. We have two types. Fund accounting and government-wide accounting. So what's the overall kind of characteristic of these? Fund accounting is like a checkbook. Checkbook, one word?
I think one word.
With a budget attached. So fund accountings are like a checkbook with a budget.
Mm-hmm.
Now, in your checkbook, you basically have cash. And when you spend something, you subtract out the cash. You don't have any record of what that really is usually. I mean, you might say that paid for whatever, groceries or whatever it was, but that isn't in your balances. It's not, and you might buy a car or something, but it's not going to be in the checkbook itself. You're not going to say, okay, I still have a car I can spend. So a checkbook is basically money going out. And so when we talk about fund accounting, we're talking about expenditures. If you buy postage stamps, it's an expenditure. If you pay employees, it's an expenditure. If you buy a truck, it's an expenditure. If you buy a building, it's an expenditure. Everything is an expenditure.
Mhm.
And expenditure is kind of an important word. It is not an expense. Expenses are generally, the terminology is generally used that expenses are for um, generating income. Expenses are the costs of generating income. We don't
Right.
generate income for governmental agencies. Now, because everything is an expenditure, you you don't have long-term assets on the books.
Even stuff like a building or land is not considered.
You buy a building, it's an expenditure. It sounds very strange, but that's the way they do it. Because if you have budgeted amounts to spend for that building, you'll have it in your budget. And when you spend it to buy the building, it's just, we're just spending it out, just like our checkbook. And there's a legal budget, so that if you generally can't spend more than you have in your checkbook.
Right.
So, but if you have it on there, you're going to buy this building, and it just becomes an expenditure. It's just money going out. Now, you don't have it on the books. There is no building. There's no depreciation. There's none of that is on the books for fund accounting.
Okay.
Now we get to government-wide. I'm going to jump ahead a little bit. Government-wide, though, they do have that. Government-wide is a little bit different, but well, actually, it's a lot of it different. But so basically everything is an expenditure. And we'll find this to do with the government-wide too. Another weird thing about governmental accounting is the revenues are not earned.
Mm-hmm.
When you pay your property tax, you don't pay this money and then they hand you something back. You just pay the property tax. So, there is no earned revenue.
Okay.
Which means there's also no unearned revenue, because basically all the revenue is unearned. So we don't use that term generally.
Okay.
Now, the budget is an important one in that it's a legal budget. We talk about it as a legal budget, and so you can't just have people spending money, because run out of money before whatever. So it's a legal budget, and so there's a lot of people putting their hands on money, saying, okay, look, you can't spend this because we got to buy a new fire engine or whatever it is. So people will put their hand on money and say, look, you can't spend this. And we'll talk about how they do that in a little bit. But that's basically the idea, is that the budget is attached to the checkbook, and that you cannot go over you can't go over the budget, but you can't go more than is in the checkbook. You can't bounce checks.
Right.
So it's a checkbook with a budget. So there's a budget, and again, everything is an expenditure. Everything is in the current year. It's a budget for 1 year, and that's all it is. It's a legal 1 year budget, basically, is what you're talking about.
Okay. So then what happens if you're, building a road and it ends up, they say it's going to cost $10,000 and it costs $20,000 by the time it's done because something went wrong?
Yeah, happens all the time. You have to generally try to find the funding for it from somewhere. And, usually somewhere in here, the general fund would get involved. Yeah, so let's say there's a capital project fund. We'll build a road, $10,000 is $20,000.
Right.
The general fund would have to find money to put in the capital projects fund, usually, to continue with it. Or they may not. They say, okay, we can't afford that. We're not going to do it, and the road doesn't get built. So yeah, and that does happen sometimes. But yeah, generally, if it goes over, the money has to come from somewhere. And so you may have a budget. So then the next year, the budget would include, okay, we have to do a what we call transfer to the capital projects fund.
Mm-hmm.
And we'll talk a little bit more about this later too. Sometimes the money collected, especially from the general fund, is not spent by the general fund. So they have a capital projects fund, and that maybe it goes over or whatever, or even just establish it. They collect the money from the property taxes, and they say, okay, we're going to transfer this money to the capital projects fund. The capital projects fund will spend. So there's also transfers in and transfers out.
Okay.
Transfer money from, say, the general fund to, let me put this up. Let's do this. Yeah, so it looked like this. It'd be like, they could have transfers. It's got close there. So you can have transfers from the general fund to the capital projects, and the general fund would call this a transfer out, and capital projects fund would call this a transfer in. Capital projects fund didn't raise this money. They're just construction.
Right.
So the general fund would fund it, but the general fund isn't. So it's not. This is a kind of a interesting point. Transfers are not expenditures to the general fund. I told you everything's an expenditure.
Right.
Well, they didn't actually spend the money. So whoever spends the money picks up as an expenditure. So here's what this would look like down here, the capital projects stuff.
Right.
Sort of like a revenue, they'd have a transfer in. And this is 10,000 just for kicks. When they spent it, they'd have an expenditure. For 10,000. And you say, well, the difference there is that revenue or is that income or loss? You don't have income or losses. If there's anything left over, they would have a fund balance. So let me show you what I'm talking about here. If they did this, let's say they spent 9,500.
Okay.
They would have a fund balance $500. Now, notice that is not income. It's just money that wasn't spent. So you don't look at this and say, hey, look, we're profitable. This is a revenue and this is an expense. This isn't a revenue.
Right.
And this isn't an expense, it's an expenditure. And this is just what's left over. Fund balance. And so, if this were the case and they built those, and then let's say the road was done, this fund balance would generally go back to, it'll be a transfer out, and then a transfer in back to the general.
And we never use the word expenditure in public accounting, right? That never.
No, not for regular businesses. I mean, the only time you might see that is like on the statement of cash flows where they say, because they're just looking at the cash going out, they call it expenditure, but we don't have those on our financial statements generally at all.
Okay. All right.
It really is just money going out. And again, it's money going out for anything.
Mm-hmm.
And by the way, for the general fund, for regular fund accounting, once this multi-million, billion-dollar project is done,
right,
it just disappears. All those zeros just walk away because they only have current assets on the books. And again, that's good because the purpose of it is the checkbook. We only have this much money to spend this year, and that's all we're looking at. We have a legal budget, and that budget means that we have to kind of stick within these guidelines. And as long as we do that, we're okay. And whatever we pay for, we pay for.
Mm-hmm.
Whatever it is. It's the same thing whether you're buying Staples or you're buying, $10 million building.
Okay.
Yep. Okay. Government-wide accounting is a little bit different. And then it's a lot more like GAAP. This is like what you'd normally have
Mm-hmm.
for GAAP. It brings up the accounting principles. And you will have long-term assets.
Okay.
You will have long-term liabilities. And you'll have expenses, including depreciation expense.
Mm-hmm.
So government-wide accounting is fairly familiar. And by the way, government-wide accounting it's not really, it's been around like 20 years, but this fund accounting has been around for 200 years. Whereas this, it's probably been more 200 years, but this is about 20 years ago. They said, look, this just doesn't giving people enough information.
Right. Like how many buildings are owned or whatever.
Yeah, you don't know what they, what they own, what they owe. None of that is on there. So I mean, and they'd have supplemental information sometimes, but the accounting itself, the financial statements, wouldn't have any of that.
Mm-hmm.
So this government-wide accounting is sort of giving that same information. Now, here's the kind of a little wacky thing is that most of your, say, municipalities and all that kind of stuff, they will do both. They're required to do both. So you'll actually keep two different sets of records. So you buy paper clips, you're going to record that in the fund accounting, you're going to record that in the government-wide accounting. You buy a police car, you record it as an expenditure in fund accounting,
Mm-hmm.
or you're going to record it as, say, equipment in government-wide.
Okay.
So you'll have two different sets of books, which again, it sounds like you're doing something illegal, but actually you're required to do it. This is because you have the checkbook. That's a legal requirement that you stay within budget. Then you have the government-wide accounting that says, okay, well, what, if this would, it's sort of like almost if this was a business, what would it look like?
Right.
Okay, so they have all of the normal things you'd see. They still have, one of the things that still is true though is things like revenues. They still aren't earned. We're accounting for it differently, but there's still no earned revenues. There's revenues, but they're not earned. This still has to do with, say, property tax and all that. We still record on the books. Now, it's very similar to what you think about as regular GAAP accounting. Other than the revenues, which are not earned, everything else, be very familiar. With one major exception, and that is the financial statements.
Okay.
Normally in the financial statements, we start out with a revenue, and usually it's for one thing. This is probably a bad example, but like the Ford Motor Company,
Mm-hmm.
Their revenue comes from making cars. I know they probably have a finance division and stuff, but let's just, a big chunk of their income. So it's one thing,
Right.
selling cars, and all the expenses. There can be dozens of expenses that come out of that. Cost of goods sold and the advertising and all that. So you have all these expenses underneath, and then there's an income number at the end. Generally speaking, for governmental accounting, it's just the opposite. They have the expenses, and then they say, okay, how are we going to cover these expenses? Okay, well, we're going to get money from here, money from here. So it's sort of like it's reversed. It's sort of like the expenses are the important number, and then all the other stuff is how do we cover these expenses on the top. So they're well, what basically is what they call their income statement.
Mm-hmm.
I'm saying that wrongly because it really isn't an income statement. They don't make income. So their income statement really kind of looks like this. They'll have the expenses, and then underneath they'll have the revenues. So let's say we'll have revenues from fees. Revenues from fines. Sales tax revenue.
Okay.
Grants. Grants could be operating grants. It could also be capital grants. Capital grant would be for buying equipment and stuff. But anyway, the idea is that you start out with the expenses, and then it's sort of just it's like an upside down income statement. So, and the expenses are usually, again, one number. They're like, okay, here's what it's going to take to run the school district. Okay, so how are they going to get their money? Well, you get some money from fees. They may have some fines for late fines, or sales tax revenue. You sell something, grants, and they might get some of the property tax stuff in the general fund. And down here, then at the bottom, instead of income, we'll have our fund balance. And again, it's kind of funny because it's the wackiest statement I think that we have in all of accounting, but it's with the government wide. Everything else in government wide is just like you would think. The balance sheet will look exactly the same.
Mm-hmm.
All the journal entries are going to look very, very, very similar. By equipment, you put equipment on the books.
Right.
You put an expenditure, you put equipment on the books, just like we always do. And, so everything else looks very the same. The only weird thing is the income statement part of it is strange, and then it starts out with, here's all the costs. They don't tell you what they are. Here's all the costs. Here's the expenses. How are we going to cover it?
Right.
And then they go through, and at the end, they will say, okay, and this will increase or decrease the fund balance. It's okay if it decreases the fund balance if there's something in the fund balance. It's okay that if this comes out to be negative 50,000, if they have 300,000 in the fund balance, okay, we can cover it. It's like on a checkbook kind of thing, right? The fund balance is like a checkbook. If it runs into a problem, if the fund balance can't cover, then usually there's widespread panic. But yeah, so this is kind of the weird thing about it. Ironically, the fund accounting, the kind of income statement thing that they use, they call it a statement of revenues and expenditures.
Mm-hmm.
It looks very much like an income statement like you normally see. So government-wide accounting, very familiar, except for the kind of income statement thing, which reverses the expenses with the revenues.
Okay.
Kind of wacky. Okay.
Yeah.
Okay. Yeah, we're not going to have any problems. Yeah, we're going to go over another page or two here, and then we'll call it a day.
Okay.
Well, you get, and I'll send out that test to you.
Yeah, for chapter 8.
Okay. So the budget at the beginning of the year. Now, this is only for the fund accounting. This is not for government wide. Let me put that on here actually. Government wide accounting. Government-wide accounting has no budget, no budgetary accounts.
Right.
Fund accounting does. Fund accounting is a legal requirement to have a budget. Governmental accounting is just like our regular accounting. You know, we now do companies have budgets? Yeah, they have budgets, but they're not on the books. You don't look at the financial statements and see a budget.
Right.
So there is no budget and no budgetary accounts for government-wide. So this is only for fund accounting.
Okay.
I know that's not a sentence, but
Right.
all right. My wife would cringe at that. My wife was an English professor. All right. She's a therapist now. Actually, she's in therapy right over here. All right. So what you have is estimated money coming in, and then you have estimated money going out for the budget.
Mm-hmm.
Now, there's money coming in, and that's what you think you're going to bring in, and be able to cover the other things that we have in our outgoing money. So, and the reason I use money is that it usually is cash. Talk about how much cash is coming in, how much cash is going out. So this is, the budget. Now, there is something very weird about it, though, if you look at it. So first of all, these are all estimated.
Right.
So estimated revenue, say for instance, estimate how much money is going to come in. Taxes, fees, whatever, however you're going to get, some of these will be property taxes, some of these will be parking tickets, some of this will be whatever, building permit fees, and it could be sales taxes, it could be selling stuff. You sell, hot dog stand in the park that the city runs.
Right.
That's all money coming in. So you have estimated revenues. Now, the weird thing is about this budget is you'll notice that these are debits. And that is odd because I don't have on the screen here. Revenues are generally always credits.
Right.
Revenues are credits. So why are these debits? The budget is sort of like a closing entry done on the first day of the year. If everything goes as planned, this is going to be our closing entry.
Okay.
So it's literally almost like closing the books on the first day of the year.
Mm-hmm.
Now, these accounts are not going to go on the financial statements because they really didn't happen. They're just our estimate of what will happen. So these are not, this looks like a closing entry. They are not actually on the financial statements. Now, when we do collect revenues and so forth, those will be on the financial statements, but these estimated revenues are not. This is a budget that just sits on the books. And it's kind of like a reminder of what is supposed to come in, and down here, what is supposed to go out.
Mm-hmm.
Excuse me. So we'll estimate our revenues. One of the things we also haven't talked about yet is we'll have estimated other financing sources. So, you're wondering, you say, okay, this is a yearly checkbook. how do we build this, this building or whatever that's going to cost 20 years to pay off? Well, they'll have other financing sources, and they could be bonds.
Mhm.
Could be transfers in. Could be the state's going to kick in some money. The state kicks in half the money for a new fire truck or whatever it is. But so it could be money that you think you're going to get from other, say, government agencies. And really any other place that they can get money from, it might be in there. It could be donations. It could be sometimes people donate to buildings, or they donate to the library fund or whatever it is. Anything that is money coming in would be in this estimated income. And again, weird thing, these are debits. It's almost like they're closing the account before it happened. And down here, estimated money going out, this is money that we're going to spend on. So one of the odd things is called appropriations. And those are just estimated expenditures. They usually don't call them estimated expenditures, even though that's what they are. They call them appropriations. And so these are what we're estimating that we're going to pay out. And it's in the government, you'll hear about them talking about the all-powerful appropriations committee. Well, that's what they're talking about. What the government's going to spend money on.
Mhm.
That's very powerful because of, how much is your district going to get, all that kind of stuff. So appropriations are estimated expenditures, the money that's going to go out. Now, again, sometimes you don't spend it all yourself. Okay, we gotta ship this money to the capital projects fund for that road repair or whatever it is, or any other use. So these are estimated expenditures. Normally, you'd think of those as debits.
Right.
With their credits. So it's a reversing entry done on the first day of the year. And what it does is it gives us our estimated fund balance. And this is sort of the important number, because this is the number that's going to tell us whether we have a balanced budget or not. This is the budgetary fund balance will be what we expect to have at the end of the year, plus or minus going in there. Now, it could be a minus as long as we have enough in the fund, in the checkbook, to cover it. That's fine. But if it isn't, so you have a budget that doesn't balance and we don't have any money in the fund balance to cover it, then you got to go back and redo the budget. It's not a legal budget.
Mhm.
So a legal budget is one that will still have fund balance at the end, or at least not go negative on the fund balance. I guess theoretically we'd be down to zero, but and still be a legal budget. But anyway, so this is the budget. It goes on the books at the beginning of the year, day one of the year. This will go on the books. It's there to guide people in their spending and so forth. And it doesn't go on the financial statements because they really didn't happen, or at least not yet. And it's put on the books at the beginning of the year. Okay. A few notes on it.
Okay.
Here. Oh, by the way, I believe this is for the CPA exam, use this budgetary fund balance.
Mhm.
The reason that's a little bit odd is because according to the GASB rules, they should be using this.
Oh.
They don't, in the GASB rules, they don't show this as an actual thing. So it's a little bit strange in that it's not, honestly, it doesn't really matter too much. But for the CPA exam, you use budgetary fund balance, and it will never be included in this fund balance below. In the past, you put it in this fund balance on the side and you make adjustments to it. But so the CPA exam, they separate it out as a budgetary fund balance. It's something completely different than a real fund balance.
Okay.
Okay. Okay, the estimated revenues. So when you estimate your revenues, you'll include all the stuff that's going to get collected the current year, excuse me, and then anything that goes into 60 days into the next period. So from July 1st, 60 days in, which would probably be what, August 29th, you're going to count all the money that gets collected in there in the year up until June 30th. So 60 days past the end of the year, you can still count that as revenues. Anything past the 60 days, so stuff that you're not going to collect past the 60 days, that is not considered to be revenues in the current year. They call that deferred revenues, which we'll don't write this down. We're going to do problems.
Okay.
But so anyway, the revenues are counted past 60 days past the end of the year. So we record them right when we send out the tax bills and that sort of thing. For things like parking tickets and that, we have to wait and see what they are. But anything that will be collected within 60 days of the end of the year is considered to be in that in the previous year. Anything past that is going into the next year. And,
Okay.
yeah. And here's the reason why there's people that'll pay late on things. So you can go into 60 days into the next year. If it goes more than 60 days into the next year, it counts for revenues in the next year. Oh, this is what I just talked about. The initial journal entry is similar to a closing entry, but it's made at the beginning of the year using estimated amount. So again, this is what we talked about. Like revenues are debits and expenditures are credits.
Mm-hmm.
Yeah, we already talked about that. A legal budget, you have to something in the checkbook.
Right.
Okay, budgets are often amended during the year as issues arise. Snow removal, oh yeah, so like for instance, you buy a bunch of salt, or you buy some salt for, if we get a really bad year, you might be buying a whole bunch of salt.
Right.
If you if you don't, let's say that we have a really light year, you have all this money left over for salt that you don't need to spend on salt. So you can transfer it to the library fund, the education fund, whatever it is. You can take that. So a lot of times these are amended. There's legal amendment, that they can be legally amended as long as they still have a fund balance during the year. And that's, it's not uncommon to have things arise. So yeah. Well, this COVID thing. I mean, the COVID thing was crazy. Right. These governments, they didn't have any money coming in, and they and they had all these money, all this money going on. So they had real problems in a lot of, and they have to amend the budget for that. Okay, so amendments are not uncommon; they're very common, and they're used as you get more information. Okay. Removal of the budgetary budget at the end of the year. So at the end of the year, what happens is you take the budget in its entirety off the books. Now, what you are going to do, though, is hopefully learn something from it and learn what, where the budget was off. Where did we spend too much? Where did we allocate too much money to that we didn't need, and that sort of thing. So you're gonna, the removal of the budget at the end of the year, it might sound kind of like, well, why do you do this in the first place? But they have to put a legal budget on the books, and at the end of the year, we'll reverse it out. Whatever's on the, whatever was on the books initially, and whatever the amendments were, those will all be reversed out at the end of the year, and those will be compared to the actual. Mm-hmm. And yeah, so usually on June 30th, they will reverse those out. Okay. I think let's stop there.
Okay.
Yeah, well, let me write that in here. Oops, nice, well, stop.
Hmm. So we'll start on revenues next week.
Yeah, and next week, we'll hopefully we'll get to some of the journal entries and stuff too.
Yeah.
It's a wacky topic. I mean, I can remember the first time I saw it in the accounting class. I felt like raising my hand like every 5 seconds. What are you talking about?
Right.
But yeah, it's but when you kind of understand why they do it, everything is in a 1 year period. A budget is for 1 year, and that's basically what you're doing. That's kind of why it is evolved into what it did. Wait a minute,
Mhm.
okay, well, what I'll do is I'll send you out the exam,
Okay, cool.
and you're doing it in Excel, right?
Yeah.
Or no? Okay. I mean, do you want me to send it to you in a PDF or no?
Not for spreadsheets.
Okay.
Yeah,
All right.
not spreadsheets.
Okay. Well, I'll go ahead. There's actually ADA, American Disability, whatever. We're supposed to send stuff out as a PDF also.
Oh, okay.
I guess I'm not sure why, but there's some kind of so I'll go ahead and send it out.
Perfect.
Just to keep everybody happy. But yeah, if you're wondering why I sent it out in the PDF form, that's why.
I mean, I guess it makes sense for Word documents, but yeah, for spreadsheets, it's always then it's over 4 pages and it's like you can't read it. So
Yeah, right. Yeah.
Yeah.
Okay. Well, I'll send that out probably like next 20 minutes or so.
Perfect.
Okay. I will
right.
see you next week.
See you next week.